Awesome. Thank you, Amy, and thank you everyone for joining us. This is our annual ACA update. Like Amy said, my name is Tanya Rule. Sorry, I had a minute for the slides. I am actually the partner in charge of the Affordable Care Act here at Eide Bailly. I've been at Eide Bailly for 22 years now. I actually am out of our Mankato, Minnesota office. I've been working with the ACA since it came out back in 2010. So we've been filing forms for our clients since 2015. So it's been a while. So with that, Sean, I'll let you introduce yourself and then we'll get started with today.
All right, thanks, Tanya, and good afternoon, everybody. My name is Sean Delury. I've been with the firm for 11 years. I've been in the industry for 16. I, like Tanya, have worked in the ACA area since it was passed in 2010, and I've worked with reporting since it started in 2015. So we've been doing this update, I guess, ever since then, and look forward to talking with you this afternoon.
Perfect. Thank you, Sean. So we're going to get right into it. So here are our learning objectives. We're not here to make you experts in the ACA. That would take hours and hours. There's a lot in the ACA. However, we want you to feel comfortable with those forms you're filing. Go ahead and ask us questions. Like Amy said, hopefully we'll be able to get to all of the questions before the end of the day. Otherwise, you have our contact information at the beginning and at the end of the slides. I should note that at the end of the slides, we put some examples in the appendix. I don't anticipate that we'll get to those. I have a gift to gab, but I'm also a fast talker, so we'll see if we can get through them. If we don't get through them, read through the examples. The answers are in there. And then again, if you have questions, let me know. The ACA, it's still alive and well. I put this in there because every year we get a few clients that think the ACA is no longer in existence. They don't have forms to file and they get a lovely notice from the IRS. We know that the ACA has been challenged 3 times up through the Supreme Court. It survived each one of those. That means that your annual reporting is still intact. So make sure you get those forms filed timely. There are several penalties that you will be issued if you don't file forms and if you don't file them timely and if you don't electronically file them. We'll talk about all those penalties in a minute. You know, we've seen a lot of notices come through this past summer, starting this past summer, I should say, to current. So a few weeks ago, I called the IRS and I said, "What's going on? You know, these are," and they're not clients we filed on, so no worries if you're one of our clients that we do the filing on. But I said, "Why are you sending out so many notices? What has changed?" Well, it's simply, you know, they're getting more sophisticated in how they're looking at the forms. They have probably better computer software. They're also questioning the safe harbors. So we'll talk a little bit about that and we'll tell you which are the best safe harbors to use to potentially avoid that questioning by the IRS. So a few updates. The 2022 instructions, as of this morning, they're still not out. Why is that important? We see the draft forms, right? The draft forms of the 1095-C mirror what they were last year, so it's pretty similar. However, the instructions are going to tell us which employers are required to electronically file their forms. Now, we know from last year, we had to e-file forms if you had 250 or more forms, and that 250 was just for our 1095-C forms, 1095-B forms. It didn't look at your W-2s, it didn't aggregate all of them together. Well, actually, if we look at the rules, last year we should have had to e-file if we had 100 or more forms. And this year we should have to e-file if we have 10 or more forms. And those 10 or more forms are an aggregate of other forms. So if I had 5 1099s and 3 W-2s and 5 1095-B or C forms. Remember, if I'm part of a controlled group, I could have that few of 1095-C forms. I would have an e-filing requirement. The problem is it takes a bit of time to get a software if you don't have one currently that allows you to e-file. And there's a separate code that you need in order to e-file those. So I would encourage anyone, if you have less than 250 forms and you are planning on paper filing those forms, keep an eye on those instructions and particularly the spot where it says the e-filing requirement. So there are always challenges to the ACA. We saw that this last month, there was a court case, that same court down in Texas, the Texas District Court. They challenged the preventative care measures in the ACA. I don't suspect this is going to have any repercussions on our ACA filing, on the codes that we're using. It's just always important to keep up to date on those court cases to see if anything would change something in the ACA reporting. As we'll see later, there are penalties if you do the reporting wrong, as the good faith effort is no longer allowed for 2021 and forward. So the IRS affordability threshold, I know we're coming into open enrollment season. That's actually gone down. So remember, that's the safe harbor that employers use when they make an offer of coverage to their employees. So for example, if I make $10,000 annually in 2022, I could pay up to $961, and that plan would be affordable to me. Coming into 2023, I can only pay $912. So you're going to want to pay attention to that affordability percentage when you're looking at your open enrollment and the premiums that you're going to charge for individual coverage. The Inflation Reduction Act. So this had a little bit to do with the premium tax credit. What it does is it allows individuals to go to the exchange to receive a premium tax credit, even if their income, their household income, is above 400% of the federal poverty line. And you might be on here thinking, Tanya, this is more of an employer update. Why are you telling us this? Because it will affect the employers, no doubt. So if I work for a company and that company offers me unaffordable coverage, and let's say my husband, let's say he's self-employed, or let's say his employer doesn't offer him coverage. Let's say our household income is over 400% of the federal poverty line. Now, the way the rules were written, if our income was over 400%, I shouldn't have been able to get a premium tax credit. Well, due to the Inflation Reduction Act, I can now go to the exchange, receive a premium tax credit, which hopefully everybody on the line knows that premium tax credit is what spurs that IRS notice, right? That if I get a premium tax credit and I was a full-time employee and had an unaffordable or no offer from my employer, that employer is going to pay a penalty on me. Couple other things. We already mentioned that good faith effort is gone. So if you make errors on your forms, and those errors lead to a pay or play penalty, which we'll talk about in a little bit, the pay or play penalty we may be able to still get you out of, but those penalties for doing an incorrect form, those are probably going to be charged back to you because, again, that good faith effort is gone. Statute of limitations. So this is kind of old news, came out in 2020. However, I still am seeing a lot of clients that shred their paperwork. There is no statute of limitations on these ACA forms. Don't simply just keep your 1094 and your 1095C forms, or your keep all your work papers, keep your signed waivers. If someone's working part-time, I would keep a copy of their hours, keep a copy of your determination. If you determine that you're not an applicable large employer, keep that documentation. Make sure that you're not shredding anything. That's the gist of it. Also, the instructions are a little unclear, or make it a little bit unclear, I should say, to employers, as the instructions say to keep that information for 3 years. That Chief Counsel memorandum is more authoritative. So remember, keep your information. We already talked about the e-filing and that we're waiting for those instructions. So we'll skip that one. And why is the IRS coming down so hard? Well, part of it is because they've had time to understand the ACA, right? We've got probably better software systems in place where we can look at those and audit those forms a little bit better. Also, remember, in June of 2020, there was a report that came out from the Treasury Inspector General for Tax Administration, and they kind of gave the IRS a bad rap in how they were looking at those forms. So I suspect that had something to do with it as well. So we're going to look at our key reporting dates. Remember, those employee forms need to go to the recipients or to the employees by March 2nd. If you're paper filing and you checked that e-filing requirement isn't applicable to you, you have to get those paper filed by February 28th, same date as it has been. However, if you're paper filing, please make sure you're doing it via a certified return receipt so you can keep that copy. We've had the IRS, actually, we just had a couple notices this week that said, where are your forms? We never got your forms. The client mailed those forms, but they don't have any documentation as far as when the IRS received those. So make sure you're keeping that in your file. Again, e-filing requirement is March 31st. Keep an eye on those state requirements. If you live in some of those states that have a form filing requirement or an offer of coverage requirement, they may have different filing dates than the federal. So with that, Sean, I'm going to turn it over to you for a few slides.
All right, thanks, Tanya. Really important on the latest developments, and a key takeaway to me that I hear and we hear from clients is that the IRS is stepping up enforcement. So kind of keep attention to that, keep that close. And there was that good faith effort for the first few years, and that's gone away. It's kind of old news. That was last year, but it's still new news to many, I think. So yeah, certainly something to keep in mind for those on the call here today. So I'm going to go over some basics here, and the main thing is that what's an applicable large employer or an ALE, and that is 50. So that's been 50 throughout the ACA, and it continues to stay there. So that's something that hasn't changed. So it remains constant. If you're greater than 50 full-time equivalent employees, then you can be subject to those pay or play penalties. If you're under 50, and this remains the case as before, then you're considered a small employer and not subject to those penalties. And one thing to keep in mind again is that it's 50 full-time equivalent employees. So that includes your full-time, and then you add in your part-time equivalents as well to get to your full-time equivalent employees. And also, as it says down below, remember to include the related entities, so that if you have parent subs or brother sister organizations, you'll want to include those entities into the count too. So it's on an aggregated basis. Some other things under the hood there for ALE status is, for existing employers, the hours calculation is based on your prior year calendar year hours. There is an exception for acquisition. So if you are under an acquisition, we'll want to look at that specifically and look at the acquisition date and go from that date forward and include that acquired entity from that point in your calculation. The other thing to keep in mind is that the monthly calc is based on 120 hours per month. So you'll see elsewhere in the presentation that full-time status is 30 hours. For the ALE status, they just use 120 a month. Not an ALE, then there is, then they don't have any forms unless you are part of a self-funded plan. So if you're you're not an ALE, you're a small employer, but you have self-funded, you would still have some forms to file. However, that filing requirement would likely not trigger any pay or play penalties. So if you don't file, then there is no pay or play penalties to you. So that's some good news there. So on the next slide, we have some basics there. So again, if you're an applicable large employer, you have 50 or more full-time employees based on the prior year. Consider aggregation again, like I said earlier. You would have, reporting that. So you would report your 1095-C and your 1094-C. So those would go out, the 1095-Cs goes to anybody that's considered a full-time employee or was enrolled in a self-funded plan. They would get a 1095-C. Because of that, you would also have a 1094-C as well. So that's some of the basics. We'll go over, we're going to go over a couple forms, how they work. So you might have, some employees that do go to the exchange, the public exchange, and receive a premium tax, or go to the public exchange rather. Then they will receive a 1095-A. They receive a 1095-A from the exchange, and the exchange will send the 1095-A to the IRS. The 1095-A form will go over on a future slide. So they could also receive, a full-time employee could receive a 1095-C. That comes from you, the employer. So you would send full-time employees 1095-C. You'll also send the 1095-C to the IRS. And probably if you're over the 250 employees, like Tanya said, then you would need to electronically submit that to the IRS. So one other thing to consider there. And as Tanya mentioned, that those codes can be challenging to get if it's new this year. So that's another thing to keep in mind if you're new to the electronic filing, or if for the first time you're at 250 or above for those filings. And so the 1095-A there on the upper left is the form that an employee receives from the exchange. And so it has some part one is just some general information about the person. Part two is some household information there. And then three is, kind of where you might spend some time on if as an individual monthly premium. It tells you that premium tax credit you would receive, and B, and then C has some more information there. So that's what they received in the exchange if they received insurance from the exchange. Then down below on the bottom left is the 1095-C. That's what the form looks like in summary that you would submit to your full-time employees. Similar to last year, part 1 is general information. Part 2 is the crux that we have to fill out, showing offers of coverage, premiums, and other safe harbor codes. And then part 3 is covered individuals if you self-fund, if you have a self-insured plan. So, Tanya alluded to this, I think, in the intro. There are IRS penalties for those, that don't file or file, have pieces missing. So, that can apply to anywhere between 2015 and 2021. As Tanya said, there is no statute limitations to this. So you want to make sure that you have your paperwork, all your information there that you described. Some of the areas that we are seeing assessments for is late filing. So we have a due date, so filing late, you have a penalty. Formatting issues, I've had some individuals, companies that sent the form that was in the wrong view, and the IRS will kick that back. If you don't correct it soon, then that could relate to some penalties. Incomplete forms, we've seen a number of forms that didn't fill out certain parts. Obviously, if you don't file, there's going to be penalties for that and non-compliance. And then the unaffordable coverage, if you offer insurance that is not affordable, then we would run into, the unaffordable coverage penalties. So let's get into what some of those penalties look like. So those are commonly referred to as the pay or play penalties. And so the first one is the pay penalty. So that's if you decide we used to say not offer coverage, and you would pay the penalty instead. So that's for large employers or ALEs. They have to offer coverage to at least 95% of their full-time employees or be subject to the 4980HA, which is the code section penalty. And so the penalty for this year, for 2022, is $2,750 per year per full-time employee, less the first 30, which are exempt. The trigger for the penalty is a little unique. It's been this way for every year, but sometimes it gets forgotten. It's triggered if a single employee receives a premium tax credit from the exchange and is full-time. So if that happens, then you would get that penalty on all your full-time employees. Let's see with that. Oh yeah, one more slide here. So pay or play. So large employers must offer affordable coverage and meet minimum value, be subject to the B penalty. So that's the play penalty, right? You're offering coverage. You have some employees that maybe don't receive affordable coverage, then you might run into the 4980HB penalty. And that's for this year, $4,120 per year. And that's per full-time employee that would receive the premium tax credit. So unlike the A penalty, this one is assessed on the individual that goes to the exchange and received a tax credit because of unaffordable coverage. So again, the employee must receive a premium tax credit from the exchange, and the aggregate of that B penalty, the nice thing that last bullet point suggests is it can't exceed what the A penalty would be. So you are limited to that in terms of total exposure for the play penalty. And after going through those slides, I will turn it back over to Tanya.
Thank you, Sean. So now we're going to talk about those penalties you'd get if you do your forms incorrectly. So we had referred to the good faith effort that is now gone. So those penalties, so let's say I do a form incorrect. If the IRS looks at that form, finds that form to be incorrect, that's a $290 penalty. Now they can put a penalty to the form that goes to the employee and a form that goes to the IRS. So you've actually got a couple forms there that they can penalize you on. So we want to make sure everybody is looking at their forms. Do a double check on them before you e-file those to the IRS. There is also a penalty if you have an e-filing requirement and you don't e-file. So make sure you're looking at that e-file, paper file, whatever the instructions are telling you to do this year. I put this in here every year. I've had this in there since I saw this article come out. I like to put this in here to just say, hey, it's more than just us that are saying review those forms. I know when we review forms for employers, usually about 2% of the employers have the forms correct. So there are a lot of changes oftentimes that will need to be done before they're submitted. So let's talk a little bit about the IRS notices that are coming out. So the letter 226Js, currently they're still working on 2019, and some are coming through for 2020. So the IRS obviously is still behind. If you have, you could still, actually, I still have one that's still in the works for 2016. Remember, since there's no statute of limitations, they can actually look at your 2020 forms, send you a letter 226J, and then they can go back and grab 2018 if they so choose. We have seen that done before. I don't know how often that happens, but you only have 30 days to respond to most of these notices. That 30 days includes the day that it's getting out of the IRS. So honestly, you've got about 20-25 days. You can get an extension on those. So they'll usually provide 1 or 2 extensions. Easier just to get them done within that 30 days and make sure you're answering all of their questions. Oftentimes, people are coming to me saying, we can't get this abated. What's wrong? Well, they're not understanding the reason for the error. So read through that notice, and hope if you have questions, let me know. The 972 CG, those notices are, again, if you're e-filing, or if you're not e-filing and you should have been e-filing, or maybe you missed the due date and you filed late, then you'd get a notice called a 972 CG. The letter 1865Cs, those have been fun lately. So the IRS is issuing a ton of those in the last, I'd say about the last 90 days. I've had a couple calls this week with the IRS saying, listen, this actual notice is incorrect. So if you get one, the problem is the IRS is changing the top of this notice, but they're not changing the body of the notice. So for example, they'll say it's a 2020 notice up on top, but the body of the notice will ask for your 2019 forms. Look for that. They're not always matching. They're not asking you for both years. Don't give them more information than what you need. The letter 5699, those are notices that are coming out from the IRS saying, hey, we think you're an applicable large employer. How are they getting that information? Well, they're getting it probably from the W-3. They can also get it if you are part of a controlled group. And if your related entity put your name on page 3 of that 1094C. So again, you have 30 days to respond to that. If you're not an ALE, they're going to ask you to submit that calculation to prove that you didn't hit the 50 full-time equivalent employees. Better to be proactive than reactive. You know, we had a client say, well, I'm just going to go in and change all the forms. The IRS sent me a notice. You can't do that. Once they send you a notice, you have to answer that notice. You can go back and look at your other years or your current year. If they're looking at 2019, you can go look at your 2020 and 2021. Typically, I see a lot of employers making the same mistakes in multiple years. Oftentimes, what is happening is they're using a software to generate their forms. But if you're not putting the correct information into the software, you're not going to get the correct information out. So see if you can do a print preview, look for those important boxes. Like Sean said, the A penalty is $27.50. I do have a calculation down here. I am going to skip that. The important thing to note, however, is if you don't offer substantially all of your employees' insurance, you're going to get a penalty on all of your full-time employees minus the first 30. Regardless if you offered all of those employees that you thought were full-time insurance, I could have 100 full-time employees, and if I offer 90 of those full-time employees insurance, I only thought maybe that I had 92 full-time employees. Even though I paid for all that insurance, I'm going to get hit with a no insurance penalty on all of the full-time minus that first 30. So like Sean had said earlier, if you offer unaffordable coverage, this penalty only goes to that one employee. It doesn't trip the penalty for all of the employees. So it's a larger penalty, but it's a better penalty because it doesn't hit all of those employees minus the first 30. So here's where we're going to talk about those safe harbors. Remember, I had said the IRS is getting a little bit more sophisticated in how they're looking at your forms. The safe harbor codes, we see a lot of employers not wanting to use safe harbor codes. You need to use those on your 1095C. For those of you familiar with the 1095C, it's line 16. So we're going to work backwards here. We have the same 3 safe harbor codes that we've always had. We have the W-2 safe harbor, the rate of pay safe harbor, and the federal poverty line. Work backwards as far as the best ones to use. If you qualify to use the federal poverty line, that is the best safe harbor to use. You don't need to have a safe harbor, or I'm sorry, that's the best code to use on line 14. If you're using the federal poverty line, you don't need to put in a safe harbor code on line 16. It's not incorrect if you do, but you don't need to. Less is more when you give information to the IRS. The rate of pay, remember, you take the rate of pay at the beginning of the plan year. You don't take into consideration any increases in that rate of pay, but you do take into consideration decreases in that pay. You take that rate of pay times 130 hours a month. Regardless if they're working 40 hours a week, it's 130 hours a month, and you take it times that affordability percentage of 9.61. The wages are your box 1 wages. Now, why do I say this is the worst one to use? What's the easiest one for the IRS to pull for an audit? It's the individual's W-2, and they are pulling those W-2s. Here's what they're doing. They're pulling the W-2s. They're seeing that you put in a W-2 safe harbor code of a 2F, and they're saying, listen, she only made, maybe I didn't make $10,000 that year. Maybe I quit in September and I only made $7,000. They don't have the wherewithal to see my termination date, so they don't know if that $7,000 was affordable for the months I did work there or not. And they'll think that that 2F potentially that you put in for the safe harbor code on your 1095C is not, doesn't calculate correct because they're looking at an annual W-2 when it's really not. So here are our safe harbor percentages. I just put those in there. I think they're important to keep in your file. If they come back and pull your 16 forms, it's easily accessible if you have it right with your forms. Sean, please, you can go ahead with the slide that's up, please.
Great, thanks, Tanya. One of the areas that I think Tanya mentioned earlier was this substantially all issue that we are seeing. Sometimes you offer coverage, and the question is did you offer to substantially all full-time employees? So the IRS later defined that as, offering 90 to 95% of your full-time employees. So that's what we would call it one of the biggest overlooked issues. And Tanya talked about it just a little bit ago. Was if, in her example, if you offer to 90% of your full-time employees, the IRS, if they catch wind of that, it's as if you offered to zero or none of your full-time employees. So what that means is you could be, you would pay for insurance for those 90% that you offered or enrolled in, and then you would pay that 4980HA penalty on all your full-time employees. So you want to make sure that you're offering, you are offering to 95% of your full-time employees. And then at the bottom, we have an article that kind of outlines that again in a little bit more detail in terms of an example of an employer that maybe didn't offer to 95% and what's the ramifications of that. So you can look at that too. So here's an example kind of for outlining that. So say you didn't offer 95% of your full-time employees, and example 1 says you have 100 full-time employees, then the penalty would be the $2,750 times 70 full-time employees, since the first 30 are free, or just under $200,000 of penalty on top of offering coverage. And then example 2, magnify that. If you had 100 full-time employees, then you could be off by 50 employees, only 50, all right, 5%, say you're off by 51, then it's as if you didn't offer to any of them. So then you would pay insurance, obviously, that you incurred, and then you'd have the penalty of $2,750 times 970 full-time employees, since the first 30 are free, or a $2.6 or $2.7 million non-deductible penalty. So what are full-time employees? Well, let's define it further. In terms of a new employee, that's one that we see, some issues with, is for a new hired employee. So it depends on the employer's reasonable expectation of the job. If it's a replacement employee, you would look at that and go, if it's a full-time employee they're replacing, yeah, let's make that a full-time employee. If it's a similar position as others, like the other positions are full-time, then it would probably be a full-time employee. Job description, advertisement, that would be considered a full-time employee. So if you're sure about that, that's a full-time employee. So if you have a full-time employee, you just want to make sure that you offer coverage by at least the first day of the month following the initial 3 full months of employment. And you don't want to have that period exceed 90 days, because there's also a 90-day waiting period rule that's part of the ACA. So usually a best practice is to have a 2-month wait period, or 60 days. Then you offer the first of the month after that. That's kind of a best practice. So So take away something from this on the waiting period, make sure it's, yeah, 60 days. So again, you know, if you don't have a full-time employee, then they're part-time and you want to make sure that they're working part-time. Otherwise, you might run into that 95% test we talked about. Oh, next slide. So it might be unclear if they're full-time. So then you'll want to look at them and say, okay, they're either going to be, the ACA would consider them variable, so you're not sure if they're full or part-time, or they're seasonal, you're not sure how long they're going to work. So you would determine their status after what's called an initial measurement period to determine their status if you use a measurement period. If you don't, then you'd have to watch their hours every month and make an offer if they happen to be full-time in that month. Let's talk about the measurement period rule terms a little bit. So there's the waiting period, which I talked about, which as you're probably aware is the period you have between when a new employee is hired and you offer health insurance to that employee. If you are using the measurement period rules, or I'm sorry, then there's two ways of measuring an employee. There's the monthly method, which is the ACA says is the default method, which is you measure hours every month and then you make an offer if they were full-time in that month or the following month as soon as, you know, administratively practical. Or you have a look back measurement period, which you will use to measure an employee's hours over that measurement period, which could be, our examples would show would be 12 months. You can use less, but we find 12 months to be the easiest and often the best to use. And within the measurement period rules, you have what's called an initial measurement period, which is when an employee just started employment and they're variable or seasonal. And then you have a standard measurement period, which you have as your ongoing measurement period for employees that are ongoing or they are just continuously employed. You have a stability period, which is somewhat after the measurement period, which is when an employee is considered full or part-time over that period. That's for that whole period. So it's a stable position, it's full or part-time. And then you have an administrative period, which is between your measurement periods and your stability periods. So full-time status, again, it is important because the penalties is based on those full-time employees. So you determine status based on the one of two measures: monthly measurement period with measurement method, which you identify full-time employees based on hours of service for that month, or use the look back, right? Which I talked about, I think I defined on the previous slide. So those are the two ways. If you use monthly measurement method, there is an optional weekly rule, which basically says you can devise your payroll period into weekly chunks instead of having it monthly or semi-monthly, or most people have, a lot of organizations have bi-weekly. So which you're technically supposed to split them into weekly periods. You can slice them into weekly periods for the month and then analyze them that way. The thing to keep in mind there is if you do, you need to know how many weeks you have in that month. So for example, you may have 4 in some months. So you take the 4 weeks times 30 hours, that's 120. That would be the measure of a full-time employee in that month. If you have 5 in a month, then you would use 30 hours a week times 5 weeks. Then it would be 150 hours. That would be the definition of a full-time employee for that month. So you would do it every month. And as you can see, that would fluctuate between maybe 120 to 150 hours a month, depending on how many weeks you have in that month. So again, let's look through the measurement period a little bit further, because there's a lot of regulation around that in the ACA. There's a lot of specific rules around there. So you want to spend some time going through how the measurement period works. So again, you have a standard measurement period, or an SMP, that applies to your ongoing employees. Those employees that aren't hired recently, they're ongoing. So those employees will be employed for at least one full standard measurement period to be considered ongoing. Then you have your initial measurement period, or IMP, and that applies to new variable or seasonal employees. That will usually or almost always be a different period than your SMP, since it's tied to the hire date of an employee. And that beginning date of the IMP begins at the start date, or the employee's hire date, or the first day of the next calendar month. I like to use first day of the next calendar month because then you have 12 of them. You don't have 365 of them. So you have an IMP and an SMP, and they will overlap at some point for new employees. So that's another thing to keep in mind. So again, the stability period is the period in which an employee's status is determined. So they're locked in as full or part-time, depending on the measurement period before it. We like to match the stability period to the plan year. That just keeps it easy and makes sure that you are offering coverage to your full-time employees come the first day of your plan year. The status will be either full or part-time during that stability period. And then again, that's based on the measurement. The admin period is again the period between the measurement and the stability period. It cannot exceed 90 days. Similar to the waiting period rules, can't exceed 90 days there. And your initial and your admin period cannot also exceed 13 months. So that's another thing to watch for, to keep in mind. So I guess if you have an initial measurement, what we do is, we just do a 1 month on that. Or if you want to have 60 days for your initial, make sure your initial measurement period is less than 12 months then. In that case. So let's go through an example to kind of lay the foundation for those rules. So we have Carter here, who is a new variable hour employee, started August 1st of 2019 for XYZ company. XYZ is a 12-month IMP, starts again 8/1/19 to 7/31/2020. That would be the IMP period. Then you'd have XYZ company as their standard measurement period, 6/1 to 5/31/21. Admin periods for both measurements are 1 month. So the new employee measurement is August 2020, and ongoing it would be in June following the standard measurement period. So let's say Carter averages more than 30 hours a week. So 30 hours a week is the full-time definition. So they're full-time during the IMP from 8/1/19 to 7/31/20. Carter would be a full-time employee then from the stability period, which would be 9/1/20 through 8/31/21. XYZ must also track their hours during the SMP. And if Carter's hours during the SMP are greater than 30 hours, then they would be considered a full-time employee during that stability period, which would be 7/1/21 to 6/30/22. Here's kind of like a pictorially how that looks. So I mean, you got an 8/1/19 IMP to 7/31/20. You got a 1 month in green admin period, and then you got the stability period starting 9/1/20 to 8/31/21. You're at the same time measuring that employee Carter for this over the standard measurement period from 6/1/20 to 5/31/21. Then you got a 1 month admin period again, and then a 7/1 to 6/30/22 stability period. So a lot of intermingling there of periods times. So you want to make sure that your process is able to handle those changes and making offers of coverage at the right time. What if they're a full-time employee? What happens then? So then they're hired, in month 1, they have a 2-month waiting period, and then month 4, they're offered coverage. There's no initial measurement period then. And then the employee would fall into the standard measurement period on 6/1/20 to 5/31/21. Admin period, is the same on month 10, and then 7/1/21 is when the next stability period would start for that employee. So again, H is the hire date, W is those waiting periods or / limited non-assessment periods. In this case, we have a 2-month there, and then the offer was on month 4. Example 3 is a different employee who has worked full-time for the organization XYZ for 5 years, 6/30/20 plan year, dropped to part-time during the standard measurement period on 10/1/20. XYZ dropped insurance on 10/1/20. And that brings up a question: was COBRA offered on 10/1/20? If not, then we run into an unfortunate situation where we have a no offer of coverage for up to 3 months from 10/1/10/31. So again, if we didn't offer COBRA on 10/1, we don't have an offer on that period, and the employee would still be considered full-time. So we run into a situation where we have one employee in this case, counting against that 95% test. We can't have more than 5%. Otherwise, again, we have that no insurance penalty. So we want to make sure that we at least minimize those, or at best, we don't have any of those. And we're offering COBRA when that category change occurred. So that gets us to monthly monitoring. Those measurement periods are pretty complicated. So you want to be monitoring that, periodically throughout the year, monthly or every pay period. So even though the ACA is at year end, you need to be able to identify who's full-time and make those offers at the appropriate time throughout the year to minimize those ACA penalties. And so this is a challenging, particularly if you have seasonal employees, variable or part-time employees who change categories like the previous example, or just, employees that are part-time that are fluctuating between, just under 30 hours a week to just over 30 hours a week. You want to make sure that you're watching them on whatever system you have, be it monthly hours or a measurement period monitoring system. So when you're looking at that, again, focuses on those particular challenging employees to make sure you're making offers at the right time. When if you have a monitoring solution, it should follow these things. It should understand clearly what full-time and what's full-time, what's a part-time employee. It should be able to track those category changes quickly. It should easily communicate trending full-time and part-time status so that you know if someone's becoming full-time or if someone's becoming full-time. And then it should be quickly communicating those results to you through a reporting system that's easy to understand. And I mean, just to put up an example, just so you can see that out here, here's one that we have that we do for clients. We do monthly monitoring. Here's an example of a report that we would send on an initial measurement period. So we have 20 employees here, just to draw attention to the first two lines of employees, EE1 and 2. They were past the initial measurement period on 8/31. They were over 30 hours a week, and red there at 34 and 30.9. So they needed to make sure we made an offer to them. The next few employees were not, and they passed their initial measurement period, and they were close to 30, but were just under. So we don't have to offer to employee 3, 4, and 5. Employee 6, we do as of 9/30 of 22. Employee 10, down below there, we would have to on 10/31 unless things change. So that's an example of an employee that's very much trending full-time, and we need to change the hours or change your staffing model or be prepared to make an offer of coverage soon after 10/31, and so on down the list. You can see that, and there's color coding there. You can see full-time is that red, part-time is that light red, and very part-time, I guess, or less than 15 to less than 20 hours a week is kind of that yellow color. So that's just an example of what you'd want to see in a monthly monitoring system or in terms of a report. Let's see, 47. Okay, hours of service. So hours of service are hours worked, but not only hours worked, but also includes the time that employee was paid or entitled to pay. So that includes not just the hours worked, but the vacation, holiday, illness, and so on that bullet point. So you want to include totals hours of service and not just the worked hours. And another thing we run into for few clients that had international operations is services outside of the U.S. is not counted. So that's a helpful thing, I guess, in terms of hours of service. And with that, Tanya, I'm going to turn it back over to you.
Perfect. Thank you, Sean. So how do the furloughs affect us? Now, I don't think we've probably had a lot of furloughs this past year. So I'm hoping that this isn't applicable, but I put it in here just in case you do. If someone's in their stability period and they go on furlough, they're still your employee. So unless you terminate them, if they're in their stability period and they're deemed a full-time employee, you need to have that offer of coverage out to them. The furlough is going to help you in year 2, right? Because then in that look back period during the furlough, you're not going to have any hours worked. So just be cognizant of that rule in case that is applicable to you. Now, when you're looking at that look back period, there are some special leaves. We have our FMLA, we have our military leave, and we have our jury duty. So if I'm out on jury duty for 2 months, my look back will be 10 months instead of 12 months. My stability period doesn't change. It's still going to be the 12-month stability period, assuming that that's what you had used. So now oftentimes we'll have a client call us and say, listen, one of our employees that was full-time for years and years and years took a part-time position. They're in their stability period. Do I have to keep that offer of coverage up? The simple answer is yes. If you offered them coverage when they were first hired after their waiting period, and if they work 3 full consecutive months after changing to a part-time position, then on the first day of the 4th month, you can call them part-time and start measuring them monthly until they complete a full SMP. So for example, on April 15th, I take a part-time position. May, June, July, if I average under 30 hours a week, then after May, June, and July, then August 1, I'd Bailey, if I'm an employee had ideally, they could drop my offer of coverage. They would continue to measure me monthly. And if my hours exceed 130 hours a month, I would be coded for a full-time employee that month, again, until I complete one full SMP. The rehired rules, we see this often overlooked. We see a lot of insurance companies not understanding this policy or this rule when they're writing their policies. If you rehire someone and you rehire them within 13 weeks, they don't get a whole new waiting period. The rules say you have to make them an offer of coverage as soon as administratively possible. The next sentence says the first of the following month is as soon as administratively possible. So if you rehire me within 13 weeks, I'm hired on September 29th. By October 1, you need to have an offer of coverage. I don't get your waiting period, regardless if it's 30 days or 60 days. If you're an educational institution, that 13 weeks bumps up to 26 weeks. Common coding, that 1A, that's your qualified offer. That's the federal poverty line we talked about earlier. So if for 2022 you offer coverage and self-only coverage is $103.15 or less, then you can use that 1A offer. Remember, when you're filling out your 1095-C forms, you're filling out line 14. You're filling out line 14 based on the offer. So you can offer it to your employee, to your employee plus dependents, or to the entire family. Maybe you're offering it to the employee and the spouse and not the dependents. That's not an ACA compliant plan, I should say, but you're going to want to look for the coding that matches what your offer is. Line 15 is a little odd because line 15 is only on the offer that you made to the employee. So even if you offered family coverage, you put the lowest cost of the self-only plan that was offered to the employee on line 15. If you use a 1A offer, you don't need to put anything on line 15 or line 16. Again, less is more when you're giving information to the IRS. If you're offering that coverage to the individual and to the employee, to their spouse, and to their dependent, you'd use a 1E offer, assuming that those offers are unconditional. With a 1E offer, you're going to want to use a safe harbor code on line 16. The 2F or the 2H, I would recommend using a 2H if you can. You need to use those safe harbors applicable. If Sean and I are doing the same job, you can't use one safe harbor code for him and a different safe harbor code for me because it fits our income. You have to be consistent in how you're using those safe harbor codes across the same type of employees. Remember line 15, you have to use line 15 with a 1E, and you're going to want to put in the decimal point. So if your plan that you offer is $100, you actually put 100.00 in line 15. Now, when we look at the 1095Cs, which we will in a minute, there's a column that's for all 12 months, and then there's each month's column. One of the errors that we often see is someone wants to fill out all 13. So they want to fill out the all 12 months box plus every single one of the months. You do either or, you don't do both. So the 1G, that 1G says they're not a full-time employee. So if I have a self-funded plan, I may use a 1G. If I have a fully insured plan, I'd never use a 1G. I'd use a 1G, again, if I had a self-funded plan and I had a part-time individual or a retired individual, or maybe I have an owner, I would put a 1G code in there. That's going to tell the IRS they can't penalize you on that person. COBRA coverage is usually done incorrectly, I hate to say. Different types of COBRA coverage, right? If it's COBRA coverage because I reduce my hours down to part-time and I take that COBRA coverage, I would code that the same way I do as a full-time employee. I just changed that dollar amount on line 15. If we jump down to the last bullet point there, if it's COBRA coverage due to termination, after the person terminates, let's say they terminate on May 31st, and then they take COBRA coverage, June through December, you'd code them as not an employee because they're not an employee, but you'd still mark the boxes down below if you're self-funded in the months that they had coverage. So here's an affordability example. I'll run through this real quick because we're kind of short on time. Again, we use 130 hours. So we would take their rate of pay times 130 hours a month times that affordability percentage. And if the insurance that we're offering is under that dollar amount, then we're okay. If it's over that dollar amount, we're not okay, and we won't be able to put in a safe harbor on line 16. That leaving that safe harbor open on line 16 is going to open you up to that unaffordability penalty that we discussed earlier, and that's that 4980HB penalty. So which forms do you file? Companies that are self-funded that are not large employers, they use those 1095B forms to file. The insurance companies, if I have a fully insured plan and I'm a large employer, regardless if I'm a large employer or small employer, if I have a fully insured plan, the insurance company will issue the 1095Bs. Here is the mistake that we often see. We'll have a large employer go to the insurance company and say, I heard I have to file ACA forms. Are you filing those or am I filing those? The insurance company is going to say, yeah, I'm filing those, thinking that you're talking about the 1095B form that the insurance company in a fully insured plan files. I have yet to see one insurance company that will take on filing a 1095C for a client. They're too complicated. They're not going to do that. So make sure when you're talking to the insurance companies that you're using the correct language so there's no misinterpretation there. So here's the 1094 form. This was the draft form that was obviously issued in July. Nothing has changed here. I do have a slide coming up saying what I typically see as errors on this form, but I'm just going to go through it while we're looking at the form, and you can look through those bullet points later. If I am filing this form and I'm not filing it as part of a division, so if I'm filing it as for an EIN and all my subdivisions I'm filing it for, then my line 18 and my line 20, or my line 18, excuse me, and my line 20 should be the same number. The only reason that they would be not the same number is if I had other divisions of the company filing forms. We don't typically see that, and we don't recommend that. What happens typically is they don't know how to fill out the 1094 correct, and it leads to multiple notices. This is page 2 of your 1094. Oftentimes I see people just getting so excited about their ACA forms, they fill out all 13 boxes but using the all 12 months and then each of the individual months. Either or, you don't get to do both. So if you say no in line 23, that's going to override all of your yeses in lines 24 through 35. Column E is reserved for a reason. You shouldn't be able to put anything in there. I have seen clients put stuff in there. Not sure why, not sure how they're getting it through on their software. You have to fill out the total employee column. The full-time employee column is dependent on if you fill out this line 22D here. Again, if you're not required to fill it out, don't fill it out. Here again are some common errors that I'm seeing on the 1094C form. This 1095C form, it's still, a couple of years ago, we had a nice 1095C form, I like to call it, because it was one page. We still have the 2 pages, and that's because of those ICRA accounts. We don't have a whole lot of ICRA accounts that are out there, so I'm going to kind of skip the ICRAs. But if you do not have an ICRA, that's an individual coverage health reimbursement arrangement. If you do not have an ICRA, you do not fill out line 17. Leave it blank. You still have to put in that 2-digit plan year. It's a 2-digit plan year. So if it's January, please put 01. And hopefully if you're using a software, they'll default to 2 digits, but I've seen some clients try to put 1 digit in there. That makes this form incorrect. Line 14, you have to put something in line 14 for every single month. Line 15, if you, unless you're using a 1A or a 1H or a 1G, you have to have something in line 15. For those 3 codes, you wouldn't have something in line 15. Line 16, again, use the safe harbor codes if they're applicable to you. This is just where you enter your covered data. You'd only enter covered lives if you have a self-funded plan. We already went through some of these, so I'm going to skip this slide. You can read through it on your own. We talked about these common errors that we see You know, if your name and social security number don't match, that's going to cause what's called a TIN error, a TIN error. Then you'll have to correct that. Ask the employee if their social security number is wrong. Make sure that you're not changing those last names until you see that they're changed social security card. Typically, it's on individuals that are changing their last name, whatever reason, typically, obviously, marriage or divorce. Do not change their last name on their 1095s until you see that social security card with their new last name on there. So when you're going through your ACA information, what do you all need to keep in that file in case the IRS comes down and audits you and wants to look at all of your information? If you keep all this information, you should be good. Make sure you keep a copy of your forms as well. Document. There's been multiple times where I get a call and they say, hey, we got a notice. We don't know where any of the information is. There's been a lot of turnover. Typically, by the time that ACA notice comes in, there's at least one, maybe two people that have turned over in that department that's preparing these forms. And so they're really at a loss. So make sure you're labeling those files well so that if you leave, the next person can easily find those. So this is a little bit about what we do for our clients. We prepare the forms for clients. We also review the forms that maybe their accounting firm is doing, their law, and a tax attorney is doing, or maybe their software system is doing. If you're not having those forms reviewed, have someone review them, whether you come to us, whether you have a second person in your office, take a second glance at them, have someone take a fresh eye and look at them because the penalties are too high to not have them reviewed. If you have questions on like your insurance plans or which is the best offering, you can also have us do that. Like I said earlier, better to be proactive than reactive. Easier to fix things before we get a notice than afterwards. So with that, Amy, I have 1 minute left. I'm going to let people read those examples on their own. I will put up my contact information. There is Sean and I's phone numbers and email addresses. Let us know if you have questions if we don't get to it, but I think there's a couple in the Q&A. Amy, let's go ahead and take those, and then I'll let everybody look at the appendix and the examples on their own.
Okay. And the first question we have here is, in example 3, how do we report on 1095-C if COBRA was offered and switched to part-time?
So let's get back to that example 3. I can see it on my paper copy. So basically what happened when COBRA was offered and they switched to part-time. So in that example, Amy, I think I can go back to that example. Yeah, let me just so everybody can understand what I'm saying. Let's just go through here. Sorry, right there it was. So I think what you're asking is once they go part-time, that's 2. Once they go part-time, remember the company dropped their coverage on October 1st. So if they dropped their coverage there and they offered COBRA coverage, you would list them as a 1E, assuming that COBRA offer was to the dependents and the spouse as well. You'd use that 1E, you'd put the COBRA coverage, let's say that's $750, and then line 16 would be left blank unless that COBRA coverage is affordable to them. That's how you're going to report that for October, November, and December. January 1st, assuming that they were averaged under 30 hours a week, so they really went part-time. January 1st is where you're going to start measuring them monthly, but they're deemed full-time for those first 3 months. And if that COBRA offer isn't affordable, you don't get to put a safe harbor in line 16. Is there another question, Amy?
Yes, awesome. Let me close that. If someone was hired as full-time but quit before they were offered coverage, do they need a form for that year?
Nope. So if someone quits coverage in their waiting period, they do not need a form. Now, if your waiting period expands more than that 90 days, yes, then you broke the rules and you have to give them a form. But if I have a 60-day waiting period, someone was hired full-time and they haven't completed that, there is no form issued.
All right, one last question here. Does that mean, I'm not sure where this was, excuse me, where I was asked and thinking around COBRA as well, but does this mean that they have an acceptable offer of coverage for the month that they are eligible to pick up COBRA, assuming they are a full-time stability period?
Yes. So a COBRA offer of coverage is still an offer of coverage, likely not affordable, but it's still an offer of coverage.